Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vontier Corporation Annual Report. Vontier Corporation offers a wide range of businesses and services that cater to various aspects of the mobility ecosystem. The company's mobility technology segment provides digitally enabled equipment and operating software solutions for convenience retail operations, electric vehicle charging networks, and alternative fuel dispensing. In addition to this, Vontier also offers repair solutions through its mobile franchise network, which includes aftermarket vehicle repair tools, toolboxes, automotive diagnostic equipment, and software. The company's Environmental and Fueling Solutions segment provides environmental monitoring and leak detection systems, forecourt controllers, vapor recovery equipment, and fuel dispenser systems. The company markets its products and services to a diverse range of customers, including retail and commercial fueling operators, convenience store owners, car wash operators, fleet owners/operators, electric vehicle charging network operators, and commercial vehicle repair businesses. With operations in North America, the Asia-Pacific, Europe, and Latin America, Vontier Corporation has established itself as a global player in the mobility ecosystem solutions market. The company's product offerings can be broadly categorized into four main areas: mobility technologies, repair solutions, environmental and fueling solutions, and IoT-based fleet telematics. These services are designed to support various aspects of the mobility ecosystem, from convenience retail operations to electric vehicle charging networks and alternative fuel dispensing. The stock price of Vontier Corp has remained relatively stable over the past year, with no significant changes exceeding 4.11%. However, pinpointing the exact cause of this stability is challenging due to conflicting information and the complexity of market factors influencing stock prices. One notable news event that may have contributed to Vontier's stable stock price is its fourth quarter and full year 2025 earnings report released on February 12, 2026. The report showed mixed reactions from different sources, with some indicating minimal movement in the stock price and others reporting a significant increase of up to 16% following positive guidance. Despite these discrepancies, it's clear that Vontier's stock price has not been significantly impacted by any single news event over the past year. This stability can be attributed to various market factors, including the overall performance of the company and its industry, as well as broader economic trends. Without more detailed data on daily stock performance correlated with specific news events, it's difficult to provide a definitive list of causes for Vontier's stable stock price. Vontier Corporation maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Vontier Corporation trades at a lower price-to-earnings ratio of 15 times and a higher price-to-book ratio of 4.78 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be multifaceted. One key factor is the performance of its segments, with some experiencing significant growth while others decline. For instance, the Environmental and Fueling Solutions segment saw substantial revenue growth in 2025 compared to previous years. In contrast, the Mobility Technologies and Repair Solutions segments experienced declines in revenue from 2024 to 2025. Other factors that can impact revenue growth or decline include intersegment transactions, capitalized research and development, tax credits, and net operating losses. The elimination of intersegment sales suggests that these transactions do not significantly affect overall revenue. However, a decrease in capitalized research and development expenses may have contributed to revenue declines in some segments. Conversely, an increase in tax credits and loss carryforwards may have positively impacted revenue growth. The complexity of these factors highlights the need for careful analysis to understand the underlying drivers of revenue growth or decline. By examining these various influences, companies can gain valuable insights into areas that require improvement or optimization to achieve sustained revenue growth. Net income and profit margins experienced fluctuations between 2023 and 2025. Initially, net income increased by $45.3 million from 2023 to 2024, driven by a rise in operating profit margin from 17.5% to 18%. This growth was accompanied by an increase in net profit margin from 12.2% to 14.2%. However, the trend reversed between 2024 and 2025, with net income decreasing by $15.9 million. Despite this decline, operating profit margin continued to rise, increasing from 18% to 18.3%. Conversely, net profit margin decreased from 14.2% to 13.3%, indicating a widening gap between operating profits and net income. The reasons behind these changes are unclear, but may be attributed to various factors such as shifts in revenue, expenses, or share repurchases. Understanding the underlying causes of these fluctuations is essential for making informed business decisions and developing effective strategies to mitigate potential risks. The company is indeed generating positive operating cash flow. This can be seen in various financial metrics presented in the extracted summaries. Firstly, on page 49, it is stated that net cash provided by operating activities was $511 million in 2025, indicating a consistent trend of positive operating cash flow for all 3 years from 2023 to 2025. Furthermore, on page 76, segment operating profit of $756.6 million suggests that the company's operations are generating sufficient revenue to cover its costs and produce a surplus, which is another indicator of positive operating cash flow. Additionally, on page 79, it is noted that restructuring charges incurred during these years were primarily cash charges, implying that the company has been managing its finances effectively and generating enough cash from its operations. Overall, these financial metrics provide clear evidence that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level has undergone significant changes over the past few years. Initially, there was a notable increase in debt since the previous period, with no specific data provided, page 9. This trend continued as the debt level increased significantly again on page 10. However, by page 34, the debt had decreased by $50 million. Furthermore, long-term debt saw a substantial decrease from $2,092 million in 2024 to $1,594.2 million in 2025, page 46. Regarding interest expenses, there have been both decreases and potential increases. On page 31, interest expenses decreased by $14.9 million, 20%, from 2024 to 2025. Conversely, on page 33, a hypothetical increase in market interest rates would result in an approximate $5 million increase in interest expenses. The impact of the decrease in long-term debt on interest expenses is mentioned on page 46, suggesting it may be affected positively. Notably, total interest expenses decreased from $75.6 million in 2024 to $69.6 million in 2025, page 64. The company's performance across various segments has been mixed, with some areas excelling while others struggled. The Environmental and Fueling Solutions segment stood out as a top performer, boasting an operating profit of $422 million. This significant revenue indicates the segment's strong market presence and customer demand for its products or services. Another segment that demonstrated impressive performance is Mobility Technologies, which recorded an operating profit of $211.5 million. This suggests that the company has successfully tapped into emerging trends in mobility and transportation, driving growth and profitability. On the other hand, the Repair Solutions segment lagged behind, with an operating profit of only $123.1 million. Despite its efforts, this segment failed to match the performance of its peers, indicating potential issues with product offerings, market competition, or operational efficiency. Management is optimistic about the company's outlook, citing its unique position to deliver end-to-end technology solutions at scale as part of its connected mobility strategy. Each segment is well-positioned for growth, driven by factors such as customer consolidation, shift towards express car washes, and increasing adoption of workflow technology as a service. The company expects a significant increase in core sales on a year-over-year basis in 2026, with management continuously monitoring macroeconomic and geopolitical conditions that may impact the business. Additionally, the One Big Beautiful Bill, OBBB, has reduced cash tax payments by $30 million and will continue to do so in 2026. Management is focused on meeting the needs of a rapidly evolving mobility ecosystem through productivity, automation, and multi-energy technologies. The company operates through three reportable segments: mobility technologies, repair solutions, and environmental and fueling solutions. With sufficient liquidity to satisfy cash needs as of December 31, 2025, management intends to use available cash and internally generated funds to meet their requirements. Overall, the company's strategy is centered around accelerating its connected mobility strategy, driving growth through various segments, and leveraging technology solutions to improve operational efficiency. The company's acquisitions and divestitures have been a notable aspect of its financial activities. Notably, there are no explicit mentions of acquisitions in most pages of the document, suggesting that this area may not be a significant focus for the company at present. However, one instance where acquisitions are mentioned is in relation to foreign operations and investments on page 37. On the other hand, divestitures have been a more prominent aspect of the company's financial activities. One notable example is the sale of its coats business in January 2024, which is mentioned across multiple pages, 11, 16, and 27. This transaction appears to be a significant move for the company, marking a major shift in its portfolio. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors. For instance, it paid $14.7 million in 2025 and $15.2 million in 2024. Furthermore, the company has also maintained a regular quarterly cash dividend payment of $0.25 per share since 2025. In addition to dividend payments, the company has also been actively buying back its shares. In 2025, it spent a substantial $300.2 million on share buybacks, while in 2024, it allocated $224.7 million for this purpose. These actions demonstrate the company's commitment to returning value to its shareholders and enhancing their investment returns. The company is facing significant concerns regarding inventory buildup and supply chain disruption. One of the primary risks is the potential for supply chain disruptions, which could impact profitability due to changes in customer demand, market fluctuations, and other external factors. Furthermore, there are issues with collecting accounts receivable and a risk of excess and obsolete inventories. Additionally, the company has experienced firsthand the consequences of supply chain disruption when one of its key electronic suppliers suffered a cyber attack that brought down their manufacturing capabilities for 3 weeks, impacting production at the Greensboro factory. The uncertainty surrounding future tariff policies and geopolitical conditions also poses a significant threat to the company's supply chain. The data also suggests that inventory levels are increasing, with raw materials inventory rising by $20.4 million, finished goods inventory increasing by $2.2 million, and work-in-process inventory increasing by $4.9 million. This buildup of inventory could lead to further issues if not managed effectively. Overall, the company must address these concerns to mitigate the risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for Vontier Corporation. Feel free to comment below, and I will be happy to answer them when possible.